Welcome, everyone. Thank you for attending today's hearing. I think we have a quorum yet, quite. We can offer the subcommittee, I guess. We have a quorum? We don't have a quorum quite yet, but we can start as a subcommittee, but I don't think any other authors are here yet. We got what? Okay. We have a quorum. Do we have it now? Consent calendar? Okay. I think we have a quorum now. We can take a roll call.
Dababneh?
Here.
Dababneh here. Allen? Asajian? Here. Asajian here. Bonilla? Brown? Chow? Chow here. Gatto? Hadley? Here. Hadley here. Kim? Here. Kim here. Lowe? Ridley Thomas? Ridley Thomas here. Stone? Here. Stone here. We have a quorum.
Okay. Let's do the consent calendar first. So we're going to do the consent calendar. If I can get a motion.
Second.
Dababneh?
Aye.
Dababneh, aye. Allen? Sajian? Sajian, aye. Bonilla? Brown? Chow? Chow, aye. Gatto? Hadley?
Aye.
Hadley, aye. Kim?
Aye.
Kim, aye. Lowe? Ridley Thomas? Ridley Thomas, aye. Stone? Stone, aye.
Okay. We're going to give our vice chair another minute to get here. He had something he was dealing with, and he'll be here shortly. And then I prefer to wait till Alan gets here. Mr. Hadley, if he is tardy after that minute, I'll ask you to serve as. I'll ask you to serve in that capacity. Yeah, he texted me. Yeah. Okay. In my eyes, you always will be. Yeah. We're just waiting for Alan. Yeah.
Consent calendar. Gatto? Gatto, aye. Consent calendar. Brown?
Yes.
Brown, aye.
We will ask Mr. Allen to join in when he can, but we will ask Mr. Hadley if you can serve as.
Where is he going to sit?
Mr. Dababneh, please proceed.
Mr. Hadley, committee members, colleagues, first I'll be accepting my own amendments as noted on page 11 in the analysis. Also, a mock-up has been provided to you. I'm here to present AB 2693, the PACE Consumer Protections Bill. These amendments come from a number of discussions with stakeholders, and I'm confident that these amendments move in the right direction to address the stakeholders' concerns and will allow for the PACE program to continue to thrive in our state. To clarify, these amendments will take out of the disclosure reference to the Federal Truth in Lending Real Estate Settlement Procedure Act, and instead will add a provision for a standard codified disclosure in statute that all PACE administrators must provide to borrowers. This addresses the stakeholders' concerns regarding their issue that a PACE loan is not a mortgage, and we concur. This also will require, in the event of a foreclosure by the mortgage lender, the delinquency on a PACE loan lien will be subordinate to the mortgage, but the PACE lien will continue. This addresses the stakeholders' concerns regarding the super priority lien and that places in statute a contractual lien subordination, which has become a standard industry practice. Y Green Energy Fund subordinates 30% of their PACE loans currently, and Renovate America has subordinated about 400 PACE loans thus far. AB 2693 is a response to the Obama administration and several memoranda released at the federal level prohibiting Freddie Mac and Fannie Mae from purchasing homes with a PACE lien. This measure brings California's PACE program in line with the Federal Housing Administration's guidelines released in 2015, a copy which has been provided to you in your documents. The FHA forthcoming proposed guidelines for PACE will address, at a minimum, lien position, stating only PACE liens that preserve payment priority for first lien mortgages through subordination, PACE payment structure, and term. PACE financing must be a fixed rate and fully amortized loan. Additional consumer protections, stating PACE programs must comply with applicable federal and state consumer laws and should include disclosures to training for homeowners participating in the program. As amended, AB 2693 follows the minimum standards as pointed out by the FHA. As with any newly created program, unforeseen issues will arise. When created, the legislature envisioned local governments taking control and running the program. Instead, the majority of local governments contracted out all tasks of the PACE program to third parties. These new unregulated entities administer and finance the program. Because of the initial legislation did not foresee new private entity structure, these new entities are currently unregulated. Currently, the PACE program lacks underwriting and disclosure requirements. I have heard countless stories from consumers across our state who took out a PACE loan and were unaware that it adds a lien to their property and unaware they would not be able to sell or refinance their house without first paying off the entirety of the PACE loan. Additionally, AB 2693 responds to several announcements released by the FHFA starting in 2010 prohibiting Freddie Mac and Fannie Mae from purchasing any mortgages with a PACE loan. Freddie Mac and Fannie Mae guarantee 90% of the mortgages in the United States, and losing this security in our state would be a devastating blow to the housing market. Initially, the announcement of FHFA in 2010 halted the PACE program, but in the last 2 years, the PACE program has picked up momentum and essentially ignoring the future impact on the FHFA's prohibitions will have on California's real estate market. AB 2693 will ensure that the next generation of PACE loans no longer creates unexpected costly burdens on borrowers. It will allow homeowners to feel more secure regarding their energy efficiency investments due to the enhanced disclosures and will allow financial institutions to feel more secure that should a home foreclose, the lender will be made whole. AB 2693 addresses the unforeseen issues raised by the FHFA and the FHA, and countless consumers, if not addressed, could undermine the success of programs in the long run and could impact the health and sustainability of the real estate market and still fragile recovering state, which it is just 5 years after the crisis that led to a recession in our state and across the country. I believe these amendments go a long way in trying to address the concerns of stakeholders, and I look forward to continuing the work as we go forward to the next committee. I want to also thank members of this committee who expressed their concerns and shared stories from their local communities of both successes and challenges that this PACE program has provided. We also want to reiterate that this is not a bill to undermine the program. I am fully committed to making sure that energy efficiency is a standard we all strive for in our communities, and that constituents in our districts have opportunities to fund these projects and make sure that our state continues to be a leader in the green energy movement. I'm fully committed to work with all stakeholders as we go forward, and I especially want to thank our colleagues who worked on this with me in the last few days to get to this point. With me today, I have Stan Wigg from the California Association of Realtors and Courtney Jensen from the California Credit Union League.
Mr. Chairman, I'm Stan Wigg with the California Association of Realtors. We're here in support of the bill. We're one of the co-sponsors of the bill. As the author mentioned, we're not opposed to PACE, nor are we opposed to green energy retrofit. But as that program has evolved over the last few years, we've found that there are a couple of consumer protections that need to be added to the program. The first is to require truth in lending on these kinds of loans. And make no mistake, they are loans, even though they're couched in statutory terms as an encumbrance on the property, a voluntary assessment. They act like a loan. They attach to the equity of the property as if they were a loan. They deserve to have truth in lending attached to them, given to the people in advance of becoming obligated, just like any other loan would do. The other thing that the bill does, as the amendments have been adopted, is that the bill changes the priority of a delinquency. It doesn't extinguish the PACE encumbrance, but it allows, in a case of a foreclosure by the taxing entity or by the lender who's foreclosing on the mortgage, it allows the delinquencies in the assessment that are limited to PACE. It allows those PACE delinquencies to be subordinate to the foreclosing mortgage or to the foreclosing mortgage, or in the case of a tax sale in foreclosure, to be made junior to the mortgage obligation. What that means is the super priority of a tax lien does not jump the PACE obligation ahead of the mortgage, jumps it ahead of everything else, but not ahead of the mortgage. And in that situation, then, it no longer endangers the priority of the mortgage and should comply with the guidance that we're hearing from the federal regulators. The bill does not do away with the PACE program. It doesn't extinguish the encumbrance in the event of a foreclosure, only the delinquency. It doesn't require separate contractual subordination as we're currently seeing, but rather codifies that practice as a standard practice so that the tax collector always knows what he or she is getting into when they do a foreclosure. It does preserve the priority of the mortgage. It also preserves the ability of a new mortgage to come in and do a purchase or to do a refi. And finally, it preserves the tax collector's role in the collecting of each installment when they send out the tax bills on a semi-annual basis. Therefore, the servicing of it is still preserved. We urge your support on the bill.
Mr. Chair and members, Courtney Jensen of the California Credit Union League, representing California's credit unions and our 10 million members in California. We are one of the co-sponsors of AB 2693. Credit unions, because of our not-for-profit, member-owned, community-based financial business model, often are the first place people go to when they're facing financial difficulty. And because of this, we hear from the ground level about issues that are directly affecting Californians throughout the state, and PACE has become one of those issues. Credit unions throughout the state have told me that they are seeing members that are unable to refinance or sell their homes because of these super priority PACE liens. PACE products were envisioned to be transferred with the property, but in reality, because of the super priority lien, members are forced to use the small amount of equity they have left in their home or cash to pay off the entirety of the PACE loan, or they are stuck. Homeowners at our credit unions have been unable to refinance to lower rates because they cannot afford to pay off the sometimes $30,000 PACE liens. We see AB 2693 and all of the provisions included in the bill as necessary consumer protections. The disclosure requirements in the bill are important and are obvious consumer protections, but reducing the lien status is also necessary and immensely important. We believe because the Federal Finance Housing Agency statements on PACE could be devastating to California's housing market. This means homeowners with a PACE lien will not be able to refinance their existing loans with a Fannie Mae or Freddie Mac mortgage, and any potential buyer will not be able to use a Fannie Mae or Freddie Mac loan for purchase until the PACE lien has been paid off in full. The amendments to AB 2693 strike the proper balance between protecting credit union members' most important asset, their home, while allowing PACE lenders to continue to operate in California and do the important green energy improvements they're doing. PACE liens coming after purchase money liens, but before everything else, will allow our members to refinance or sell their homes and will alleviate the concerns of the FHFA. This compromise will better align the lien with the vision of it transferring with the property. If credit unions were proud to have worked proactively with their members during the last mortgage crisis to modify their loans and keep people in their homes. However, if California is hit with another market downturn, the state's credit unions fear they will have limited options to help homeowners who have agreed to have the super priority PACE lien attached to their properties. We believe AB 2693 in mock-up form before you today ensures California's public policy goal of reducing greenhouse gas emissions and works in harmony with the state's other urgent goal of housing affordability for all California citizens. Thank you, and I respectfully request your aye vote.
Mr. Chair, committee members, Pat Zenzala from KP Public Affairs. I'm here on behalf of the California Mortgage Bankers Association. And mortgage lending is currently facing unprecedented regulatory scrutiny in California. To protect consumers and to protect their homes, AB 2693 is simply going to provide some basic consumer protections statewide when local governments are promoting PACE financing that put a significant lien on a consumer's home. For that reason, we're in support of the bill.
Mr. Chair and members, Kevin Gould with the California Bankers Association. We are also a co-sponsor on this important measure, and we respectfully urge your aye vote.
Mr. Chair and members, Lexi Howard on behalf of the California Escrow Association, California Mortgage Association, and United Trustees Association, also a co-sponsor, and urge your aye vote. Thank you.
Mr. Chair, member Shane Levine on behalf of the California Community Banking Network in support, and also Solar City, who's neutral. I want to thank the author for taking the amendments to exempt commercial projects. Thank you.
John Caldwell on behalf of the California Land Title Association. We're also in support of the bill.
Thank you very much. Any other witnesses in support? Witnesses in opposition? We'll be allowing 2 witnesses on each side, 5 minutes total.
Thank you, Mr. Chairman. I'm Janine Windishausen, Placer County Treasurer Tax Collector since 1993 in Placer County, and also the administrator of Empower Placer, the PACE program, since 2010. The Empower program has provided financing on about 1,500 properties totaling about $48 million, most of it residential. The Empower program has created 1,000 local jobs and the carbon reduction equivalent to taking 678 cars off the road annually. PACE programs have proven to be an excellent tool for helping California achieve its climate goals, and PACE financing is based on assessment lien financing with priority lien status that has provided numerous public benefits to California communities for over 100 years. However, increased regulation and disclosure is needed to ensure that all programs operate with the transparency and responsibility to constituents that are required of city and county operated programs. This is an excellent opportunity to improve PACE and prevent abuse of the municipal taxing authority and bonding authority. Profit-oriented PACE programs have led to unregulated lending, unintended consequences, and failures to meet the original spirit of PACE as a local government program. In these areas, my tax collector colleagues report increasing time spent explaining PACE assessments to property owners who don't understand the added assessment on their property tax bills. Programs run by cities and counties focus on achieving climate goals, resource conservation, utility saving, and job creation. You should know that until September 15th, Placer County experienced a number of refinancing of its liens. I beg your pardon, I have allergies. I'm not really crying. Out of 210 parcels subject to refinancing, the lien remained on 91% of the time. Out of 45 parcels sold, the lien remained almost 70% of the time. Lenders who previously allowed the lien to remain would no longer do so. Maybe there is someone here today who knows what happened. Maybe one of the committee members could ask that question. In spite of the opportunity to improve PACE with AB 2693, there are complications. The proposed amendment in the bill analysis regarding disclosures does not go far enough. It does not include a requirement for a 3-day right of rescission, and it does not prevent using other interest or cost calculations for marketing purposes. Further, any type of subordination lien status on the tax bill creates complications for county tax collectors, including the proposed amendment and limited or contractual subordinations. Under limited or contractual subordination, the tax collector is still obligated to sell the property in 5 to 9 years under California Revenue and Taxation Code, and the sale of the proceeds if the sale of the proceeds are insufficient to pay all taxes, the assessment lien will survive. Any subordination lien is unacceptable since PACE assessments are backed by municipal bonds. Subordinate lien status will render PACE bonds to junk-bound status, eliminating PACE's ability to achieve climate policy goals. It may also confuse the municipal bond investors, sending a message that is confusing about the status of municipal liens in California. All programs should operate with the same transparency as local government-operated programs. The committee should consider that private sector providers be regulated under the State Department of Business Oversight or other state regulatory authority.
And ma'am, if you could wrap these up, we want to make sure all
I
of
am
these
right
are
now. We're asking that you require standardized disclosure and require a 3-day right of rescission, require ethics training, monitor other consumer protections, and provide administrative procedures and remedies for consumer complaints.
Thank you.
Thank you, Mr. Chair and committee members. I'm Jane Elias, Program Manager for the Sonoma County Energy Independence Program. The Energy Independence Program is the longest-running residential and commercial PACE program in the nation, and it operates as a municipal program. The county owns, operates, funds, and invests in it. The program has a pool of county funds to provide financing for property owners and the bonds created by the voluntary participation of property owners that are then bought by the county treasury as part of their investment portfolio. Sonoma does not use private capital for its program. To date, we have successfully financed over $73 million worth of PACE financing for energy, water, and solar improvements. Solar projects financed through the Energy Independence Program equal 10.5 megawatts installed in Sonoma. This is nearly 20% of the installations commissioned since March of 2009 when the program began, and that's equivalent to removing 1,951 cars off the road. Over 89% of the projects are done by local contractors. We've created or retained over 1,475 jobs, and the improvements financed have resulted in over 61,441 metric tons of CO2 eliminated over the 7 years of the program. In 2014, Sonoma opened up the Sonoma County PACE Marketplace, thus allowing private, for-profit PACE providers to operate in the county. As a condition of the marketplace, operators signed a collaborative services agreement with the county. The intent of the agreement was to establish certain criteria ensuring private PACE operators had program standards and protections in place, given this is a financing tool that currently has no state or federal oversight. Sonoma County not only holds responsibility to the community as a local government operating its own successful PACE program, but in allowing private for-profit companies to operate in the county, it wanted to make sure that they operated with the same integrity, and the agreement allowed for county oversight and gave a mechanism to address bad actors. As a result of that, we've had 3 additional members join the county, and they've been working with the cities, which has been a little more challenging as they have not come on board at the same time. Some of the issues that have been identified throughout the marketplace is the Energy Independence Program staff did not anticipate the kind of oversight requirement that would be needed in order to oversee these other programs. And as such, we have identified several issues. Private PACE companies rely upon the contractor to drive the program and give the contractor many controls and resources rather than putting the power in the property owner's hands. Contractors should not know what the available equity is in the home unless the property owner wants to share that with them. Data sharing does not meet the requirements set forth in the agreement. property owners applying to multiple programs and programs not knowing whether or not there are other applications out there. The other PACE liens are not calculated into the lien to value ratio formula, and some providers do not have a mechanism in place to identify those liens.
And ma'am, if you could wrap up your comments, please.
In summary, Sonoma has risen to the challenge that the governor and the legislature put forth in tackling the greenhouse gas emission reductions throughout California. Through our efforts of creating and operating a municipal PACE financing program, Sonoma is helping to meet these goals and reverse the effects of climate change, and PACE financing has been a big part of that effort. This bill, as it stands, would not be good for Sonoma County, especially if the lien status is changed from the current form under which PACE operates. Changing the lien status from a tax lien to any other kind of lien will kill PACE and would effectively remove the tool off the table as an option for Sonoma County property owners to utilize in the reduction of greenhouse gas emissions. Sonoma County respectfully opposes this bill unless amended. Thank you.
Thank you very much. Other witnesses in opposition, and please just limit to your name, organization, and position on the bill.
Eddie Moreno on behalf of Sierra Club California with an opposed unless amended position, and we appreciate the author's efforts to work with us.
Mr. Chairman, members, Will Gonzalez on behalf of the California Solar Energy Industry Association. Bill in print, currently opposed. Look forward to working with the author. Thank you.
Corey Bullis on behalf of Environmental Defense Fund. We have yet to look at the amendments, but in its current form, we're opposed to the bill.
Genevieve Gale from the Sonoma County Water Agency. We have not seen the amendments yet, but we are currently opposed. Thank you.
Cliff Staten with Renew Financial. We administer the California First program, and we're opposed to the bill.
Joanna Voris here on behalf of the Urban Counties of California, also in opposition. Thank you.
Mike Lemaire, Wide Green Energy Fund, Administrator for Golden State Finance Authority and RCRC, oppose.
Erin Niemela representing the Efficiency Council. We also have not seen the amendments yet, but have an opposed position on the bill. Thank you.
Kara Martinson on behalf of the California State Association of Counties in opposition.
Jewel James on behalf of Renovate America in opposition to the bill.
Jason Ryan, League California Cities. We are also opposed.
Brett Barrow with the California Chapters of the National Electrical Contractors Association and the California Legislative Council of Plumbing, Heating, Piping Industry. We are currently opposed, but recognize the amendments taken to the bill today and will be working with the author. Thank you.
Yes. Great. Any other witnesses in opposition? Let's go to questions from members. I missed one. Here we go. Please.
Thank you for allowing me to speak. To Chairman Bobney and Vice Chairman Allen.
I think we're at the point now. We've already heard both of our witnesses that we gave the appropriate amount of time to. Now we're just limiting to name, organization, position. I'm sorry, ma'am.
Okay. Well, I am a City Council member from the City of Banning. I did fly up specifically for today, and I'm also the second Vice Chair for the Western Riverside Council of Governments, and so I am here to speak in opposition to it.
Okay. Thank you.
Debbie Franklin.
Thank you so much, Councilor. Great. And now we're at questions from members.
Yes, thank you, Mr. Vice Chair. Mr. Chairman, how significantly do these amendments, I haven't seen them in the comparison, so as compared to the bill in print, what are the significant changes, not the technical or minor, but the significant amendments?
There's several things that we've done. One, this no longer affects any commercial properties. Commercial properties have a unique place in the marketplace. A lot of the energy efficiency programs that we're trying to obviously jumpstart, especially came out of SB 350 last year, revolve around commercial properties. That is not touched by this bill. Secondly, we've gone back to, so I know some of the comments, and I actually want to applaud both the speakers from Sonoma and Placer County for the work they're doing in their counties. I think those two counties have the real intent of what this bill that goes back to, I think it was 2008, really envisioned. And those counties should be applauded for their work. But one thing I would like to correct for the record is we have not taken the super lien status away. It is not a judgment lien that we're talking about. We are taking the super lien that is currently in effect and making it contractually subordinate to the mortgage. But it is not a judgment lien. It is still a super lien status that is now junior to the mortgage and only the mortgage. Okay. This is also important because there is no limit. Someone could take out multiple liens for different projects. We've seen cases where someone took a lien out for window improvements. Someone then, the same homeowner, took out a lien for insulation work. Then they did it for a water heater. Then they did it for solar. You could have 4 or 5 super liens on one property because you're not doing underwriting and because there's no other specific regulations that prevent that other than the capacity that you can't technically take out more than the home is worth.
Right.
We're also changing so you're no longer using basically the Truth in Lending Real Estate Settlement Procedure Act as the basis for the disclosure. We're now creating a new disclosure form that will be standard, but we're not treating it as a mortgage disclosure. So that was also a significant hurdle that we had in our discussions with the stakeholders.
Okay. I don't doubt that this issue may have come up in your district or from the proponents' bills, but just so you're aware, and I think you probably are, most of what I understand about PACE and I hear from my constituents is, and it's not broadly based, but it's generally understood, are to help with energy efficiency in residential settings, primarily. That's what I understand it to be, and have been very popular and potentially growing. Secondly, with respect to the concerns that were mentioned, maybe not as much about you in your opening, but with witnesses who are supporting, if there's a concern about a local government and how it contracts through PACE, if it has a contract with those private providers, it would seem to me that a violation of that contract would be a violation of an agreement with the local government, and thus an issue for either county council, if it's a county or city, or the city attorney's office of the city, or the district attorney's office if they're violating the terms of that agreement, if you feel that there are fraudulent practices. So LA County, for example, we have our own consumer affairs department, so that if someone is making fraudulent suggestions in any type of commerce, we have not just the Federal Trade Commission, not just the state's regulatory apparatus, but also a local tools in order to fight for consumer protection. Lastly, I don't know that the issues that may have been challenging, let's assume that the credit union members are raising issues. Let's assume that realtors care about this for some reason, or they hear from their potential constituents, or customers, rather, is the correct word. In Los Angeles, I don't know that to be the case. So if there is with your indulgence, Mr. Vice Chair, if there are proponents or supporters who have specific Los Angeles issues, and they can say it's doing well, or there are issues, or we're working on it, or we deal with it this way, if the vice chair is open to it, a very brief comment from the LA people if they are here, because this is not, from what I understand, currently a Los Angeles problem. As a matter of fact, it seems to be a Los Angeles success story. The PACE program, as currently constructed, with super priority, the very first type of lien for financing purposes. But with the Vice Chair's indulgence, and Mr. Chair, if you...
Well, I'll answer. I will tell you,
you're an LA guy.
This is a state problem, because at the end of the day, we have a very specific solution to not, I think, endanger the program overall. But I think these debates kind of remind me of the housing crisis, when there were certain mortgage products that are being provided that were very popular with consumers, and people took great equity out of their house through these offers. And what you had was a defense of them, because it increased home ownership, it increased people's ability to have liquidity to do housing improvement projects, to pay off other bills. And this led to the housing crisis, obviously, where people then all of a sudden lost great percentage of that equity to the market, and now they're upside down their house. This is a very, I think, noble goal that we want to see continue. We want to make sure consumers of all income brackets from all our communities have access to programs like this, to be able to retrofit their house, to save money, to make it more energy efficient, to expand the reach of solar, and make sure that all our consumers can do so, though, in a safe way that does not compromise the biggest investment they have for most of our constituents, which is their home. this is not a matter of if, but when this will cause a crisis in our housing market. Because when you think about this, FHA since 2010, FHFA, and recently FHA have come out with memoranda stating that Freddie Mac and Fannie Mae will no longer backstop these loans. That is not only an LA issue, that is a state issue of great concern. Now, I will make clear, though, as some of the opposition did say, I think it was very noteworthy that the opposition today actually called for greater disclosure requirements than this bill even asks for. But I do feel like we have a very real issue that affects all of our homeowners and all of our communities, and that I do think we have a reasonable solution here. We're still open for further amendments and having a discussion, dialogue as we go forward. We're going to be taking this to more committees on our side, and I know before it goes to the Senate, there's more opportunity to include some of that. And I look forward to working with the opposition that I heard from today, especially in their situations and how their county-run programs are administered. But I truly do think this is not only an LA issue, it's a state issue.
If you don't mind, Mr. Vice Chair, if there's anybody, either supporter, aside from the chairman, or opponent who has a specific Los Angeles perspective, very briefly, if they can speak, if that's okay with you, Mr. Chair.